but there is around 40 minutes which we have to complete all of our panel. But I'll tell you what we are going to concentrate on. I think from morning you would be listening about a lot of AIFs and rules, regulations, etc. But we are not going to talk about that. This panel is slightly different. It's going to concentrate more on asset classes and diversification as far as a client's portfolio is concerned. So we've got a very esteemed panel and a mix of asset classes which you can talk about. So to my left, Shobhit will talk about real estate, and Sasha and Bharat will talk about, we can introduce venture capital, maybe a little bit of private equity if you can represent that community as well. And then Ravi, we can move on to high yielding credit, which has become one of the most emerging alternate asset classes globally. Right? So alternate assets now become around $4 trillion in terms of size as far as global investments are concerned. The largest being real estate, right? So real estate out of that is around 1.4 trillion, out of that 4 trillion. So when we look at that, and it's extremely liked asset class as far as both Indians as well as far as global investors are concerned. So maybe Shobhit, your initial thoughts on when say, for example, if a client wants to see a real estate product in terms of an alternative AIF, vis-a-vis if he could buy the real estate himself, right? So do you think there is some kind of diversification he's getting in because he's getting into a product which is more structured like an AIF?
Strange, you asked me first. Usually in all these conferences, real estate sits in the corner. I get the center stage, so I'm very delighted. Generally speaking, to answer your question, I think about 2009 or 10, whenever AIFs started, it actually allowed financialization of real estate, which was not available before. So traditionally, people saw this as wealth asset. They bought it because they wanted to park surplus money. They really weren't looking at income returns and hoping for, I think the common belief was land is not getting manufactured and the price will keep going up. Contrary to that, in the last sort of 5 years, it's not been the same, right? So land prices haven't really run up. And people, because they've got access to instruments that allow you to invest or fractionalize the ownership of real estate, I think it's important, and I think people have made money on it. So it's a good thing overall. It's part of the corporatization of the sector. Also allows not so wealthy people to participate as opposed to only the super rich. And what it has done in some sort of a way, which is a sort of side effect, is as more and more alternatives or family offices, AIFs, NBFCs, HFCs are vehicles are being created to put wealth in it, the less of political money is coming in. So it's really flushing out a lot of the dirty money, which it is very popular for as a laundry machine. I think that's going away, and that's where the pain is starting to see. Government has stepped in, regulations have come in. Earlier, this was the same guys who didn't want this sector to be regulated. Now regulations are coming in, and institutional money is coming in, and we're finding that there's a whole cleanup act that is happening and feeling the heat somewhat, because the past is still sort of catching up with us. But going forward, with the advent of all of this, and now REIT, hopefully in the next 2-3 months, if the timing is right, so it'll give lot more access to smaller ticket size investments, which are professionally managed, and the right products are all there. So we are pretty excited, saying we hopefully will get a larger share of wallet going forward. Yeah.
Great. So moving on to the VC side, of course, as far as data is concerned, AIFs have now raised around 1,80,000 crores. That's as per the SEBI website on June. So I think in the later 6 months in 2018, we could have gotten more money, which is not yet, the numbers are not yet out, but I'm sure there has been very strong growth in the AIF category as such. A large part of it is gone into venture capital, and thanks to government intervention through SIDBI and SIDBI being in LPs as most of the VC funds. But when I look at it from, say, for example, clients, how different is this vis-a-vis from a correlation perspective or even a return perspective to something like, say, small cap listed equity? I know this is a weird question or a very different question, but let's assume if small cap stocks are still liquid, you can get out. There's illiquidity in smaller private equity companies. How do you see VC and P together? I'm asking it together. How do you see both of you? Maybe if you just want to.
Yeah, so actually I'll take that, as Umang has mentioned, that because over say close to 2.5 decades, I have straddled across strategic assets, moving on about 10 years back, to sort of look at private equity, and then last few years, I think probably on the VC and the angel space. So I think the way it pans out to an extent, I think, let me sort of drift back a little bit to say that it has to do with the sort of the set of the universe of the LPs or the investors. And there are different classes, so you will have maybe, the international, I'll not sort of touch upon because it's a very evolved space. These people have been investing in alternate assets across VC and PEs, I think for almost like 4 to 5 decades. In India, I think you have 3 or 4 basic classes of LPs or investors looking for alternate assets. So one would be clearly, I think, very well-to-do professionals who have sort of built wealth, and they don't have sort of time to manage their own money, and instead of direct investing, they look for alternate assets. That's one class. The second one typically would be sort of family offices, where I think there are next generation, I think, in the family office who probably look at their own assets also as a financial private equity asset, that so long as it is creating financial value, they are interested. Beyond a certain point in time, they might want to convert that into sort of real cash and deploy it somewhere else. And while doing that, in parallel, they would have a kitty to deploy in alternate assets. So that's the second class. The third one would be probably institutions, where you would have provident funds and pension funds in India, or maybe even insurance companies, which have started, I think, in some form in last few years' time. So the solution and the approach, I think, for each one would be different. I will confine it to probably family offices and maybe professionals and sort of HNIs. I think, because that's more relevant. I think institutions have their own framework. And which is where, if you see, Umang asked a very important question that, how do you compare relatively illiquid asset class like a venture capital with, say, public market of small cap stocks, if one has to say. There's one broad difference, if you go to the principles of investing, I think you have security and liquidity, and depending on where you want to sort of be on that curve or sort of on that sort of axis, will determine on what returns would you get. And if you want to sort of transverse that kind of a equation, then what kind of a return that you expect would have an impact on what kind of a liquidity and the security that you would get. It's sort of fathomable and unfathomable that you would expect, I think, a 15% kind of a return from a government security, because the security level out there is 100%. So it can't give you that kind of a return. So there's an interplay of these three, and that's the same place where, comparing it with a public market and sort of a illiquid asset class is that typically, I think, in a pooled asset structure on a illiquid asset and unlisted asset class, usually, I think, as you say, that you fire one bullet and, sort of you get that outcome of that a few years later. Very rarely you would see a pooled asset class in venture capital where, despite it being, taking a, whether it is a seed series or whether it is pre-series A or series A, series B, that you will see portfolio churn within the lifetime of the fund too much. That you will see maybe at best, I think, maybe one churn. And what that means is that maybe in a span of about 8 to 10 years of the fund life, you would dispose of one set of investment that you had invested at the beginning and invest it back again. That brings a discipline in terms of how you are trying to create a value And that's a broad difference between a VC fund and probably a small cap public market fund, where because there is liquidity, even if it is limited, it tempts at times, for churn. And that at times I think probably can determine, what kind of a compounding that you can get and whether you are able to sort of get caught in the cycles of the public market investing. So that's, I think, one investing. But on the VC, I think I would leave it to sort of Sasha.
I think, can everyone hear me? So Bharat has answered the question very nicely. So I'll just give two examples to add to what he said. And I think the word is liquidity, right? It's all about patience. Our asset class, venture capital, especially what we do, early stage, requires immense patience. I'm talking about funds that are 10 to 12 years, where you can actually really make serious money. If you're not patient and you need liquidity constantly, then this is an asset class that you should think of not getting into. Maybe at best, I would say, a certain percentage of your net worth, maybe 10% at best ever. Now, I'll give you examples. So I started investing in 2001-2, which is 15, 16 years back. The companies that I've held on to, the ones that I really like, have now started breaking out. And I'm talking about disproportionate returns, substantially better than any market returns can get me, whether it be mid caps or small caps for that matter. I'm talking about returns of 100x plus, right? Maybe 200x, 300x. But all this takes time. It's great for me to sit on this table and talk about the 100x returns. But if you're not patient in this asset class, I strongly recommend you think about not entering this asset class. Because if you get in and get out, you're only making 2x, 1x, 3x, which makes no sense. Because at the end of the day, 2x you can just do it in mid caps and be happy. And you can press a button, HDFC, that's not a mid cap, but get out in 24 hours. And so my father runs a family office, for example. He only puts a certain percentage of his money into funds like ours. Now the second example is, today morning I was reviewing something called Mumbai Angels, which I co-founded 10 years back. Sachin, who runs it, is somewhere in the audience. And I told him to do a math of the last 12 years since we started this. And we had no clue. So I was very pleasantly surprised at the returns. They were outstanding. They were better than anything I could have done in public markets. And how does that happen? I mean, remember, Mumbai Angels is a network of people like you, rich people. It's not one fund saying I'm good or bad. It's multiple people. And there are many silly decisions being made where I'm shocked where some investments are made and some investments should not have been made, have been done. But the returns, because it's like an index fund. So over 12 years, all the mistakes, right and wrong, bottom line, the numbers are there, they're shouting. And I was absolutely shocked. I can't disclose numbers publicly, but I'm happy to talk about it offline to anyone. The numbers are just amazing. So it's all about just waiting it out for those 12 years. And so my two bits are patience in this asset class is very important.
Great. I think moving on to Ravi. Ravi, you know what happened in September, October. Of course, IIFL and its aftermath on mutual funds. And you've been running high-yielding credit funds. Now, when you're now meeting investors and talking about this asset class, and when somebody gives you an example of what's happening on the credit space, how would you respond to that question?
That's a very pertinent question because that's the first thing we get encountered, especially since at Northern Arc we run primarily NBFC focused funds, and it was an NBFC that went down, right? The only difference being that we are in the lower down the credit curve kind of instruments, whereas the default that happened was in a AAA. But the question on debt definitely comes in because if you see what is the underlying thought behind the question, it is debt is always thought of as capital protection. As soon as somebody is selling you equity, you have the expectation that there can be some capital loss. When it comes to debt, capital loss is anathema. So that kind of distinction really builds in. Right? So we did face that question, and to just quote on what has happened, our funds were not impacted at all in terms of either credit events or you can say return shortfalls. Our funds are structured such that we pay out all interest quarterly, and both in September as well as December, the payouts happened in full without any delay or without a rupee shortfall. So you can say that kind of piece is uncorrelated. So within debt itself, there are many, you can say, you can diversify across debt, right? Earlier, you can go from risk-free, you can go from tax-free, you can go to private debt, there's real estate, there's venture debt, and there is now a plethora of options which are special situations or also stressed assets. All of these are uncorrelated to some degree. Right? So while IIFS has gone down, And there was a huge question in terms of the debt repayment capacity of other AAAs which were in mutual funds. On the private debt side, we did not really see that kind of issue. There was a lot of questioning, obviously, from investors. And now that that phase has passed, the returns have come in and that has been allayed. But that really shows into account on what is the value of diversification. And that's what this panel is about as well, in terms of taking exposure between debt to different asset classes. Now, one of the reasons why you mentioned in the earlier part was why private debt has taken off. Right? If you compare with the last couple of decades in how the Indian industry has evolved, equity is something that my father used to invest in, direct stocks and fixed deposits, whether it's a Kisan Vikas Patra, whether it's bank FDs. Administered interest rates were the way to go for your fixed income allocation. Right? And the third asset class used to be real estate, direct. Now, with administered interest rates coming off, and fact is that most of the equities also moved towards mutual funds, there is a lack of similar products on the debt side, especially in the mutual fund space is what we've seen, largely because of daily liquidity. So when you have short-term kind of debt instruments, it makes sense from a mutual fund angle. But when you're looking for that kicker in terms of returns on the debt side, more than a fixed income or more than a fixed deposit, then you have to come to the private debt space, which has kind of led to the, you can say, explosion in the private debt space. Globally, in India, I wouldn't call it an explosion yet, but we are seeing a lot of interest, especially on the debt side. Conversely, post IIFs, we've seen a lot of inflows into our funds, so which is really surprising to me. But the fact that we were able to demonstrate that there has been no liquidity event or a credit event has helped in gathering future flows. One point on the structure as well. Traditionally, because debt has been thought as safety, expectation is of instant liquidity. And instant liquidity in a mutual fund platform which is taking credit has seen some after effects, especially post IIFs. So when you structure the private debt on an AIF platform where you have controls on liquidity, gating, as well as you have discretion in terms of how you want to plan the cash flows, that kind of matches the appetite a lot more. So I think that's worked out quite well.
Great. So thank you, gentlemen, for just introducing all your asset classes and telling the audience how they can diversify portfolios. I just want to go now to the LP scene or the investors which you're interacting in each asset class. I'm sure you're meeting very different kind of set of investors because say it's a different kind of investors for real estate and different kind of investors for VCs. But generally what we see in the international markets is in the $4 trillion, a large part of it is through institutions like insurance companies, endowments, etc. Whereas when you look at the Indian scene, when you're looking at that 1,80,000 crore number, it's predominantly HNIs, SIDBI, and maybe a few insurance companies. So that's basically the market. So a few thoughts, from you gentlemen on the evolving LP scene and how do we get it to a larger institutional scale. Also, Sasha and Bharat also on thoughts on, when SIDBI is coming in and say somebody, so they say that 25% is what they're going to do. And if they have a corpus of say 10,000 crores, are we building a VC 40,000 crore bubble and there's no follow-up funding after that? So some thoughts on how we are evolving in this space. I don't know, any of you want to start first?
Yeah, so one input on that I think Umang I'll have is because I've been involved with the alternate asset class, I think at least for last about a decade, that I think, we are a young country in that sense from the perspective of the alternate asset classes. So, the history is hardly about 10, 12 years, since when private equities itself, started in the country. So, and again, I think insurance penetration in the country actually is pretty low as of today. So, the point is that, maybe, your traditional, I think, LPs or investors in VC and PE funds would be that single life insurance corporation, because that's the only one who has that kind of corpus to be able to contribute 1 or 2% of their corpus, still, absolute amount being a large one. So as we sort of mature in terms of the asset alternate class, in the country, you would see more sophistication and more distinction in terms of what kind of strategies that each of the fund is offering. And specifically for say VC, I think let me give you an example that VC itself I think is a very, very broad term. I think if you would say it starts from an angel investing to then sort of a seed stage to then sort of what you call a pre-series A, then a series A, and then you have a series B, series C, series D. So as of today, I think what you saw is the first generation of venture capital funds that were operating in the country, homegrown, including one from Sasha. These are the ones who have found their sort of niche. I think in last 5 or 7 years' time, going through maybe 2 or 3 rounds on what is the particular, I think, phase of the VC investing that they would want to sort of focus on what they are best at. So there are few funds which have decided that they would want to say probably at best at the seed stage level. Belief is that that's where they can influence the portfolio company the maximum and the biggest bang for the buck, because that's a level where you get in and where you get a reasonably, I think, entry level valuation, and with your own influence and your impact on the portfolio company, you are able to build huge amount of value out there. So that's, I think, one stage of investing. But again, it comes with its own what you call bankruptcy risk of the portfolio companies. As you move up the chain, I think within VC itself, I think for Series B, Series C, where you are seeing $50 million, $100 million, $200 million kind of ticket sizes, I think, being invested. Barring a few, I think there again the bankruptcy risk of the portfolio companies is going down. So again, in terms of the asset class, I think it will be different in that kind of a scenario. Within private equity, again, it's the same, that where probably a VC is letting off, I think a private equity is coming in. And then at that level, then again, you'll have private equities which are sort of good at what you call growth investing in mid-market companies, and then going up to sort of buyout funds and all those kind of stuff. Yeah. So I think each investor has to find their comfort and the niche, I think, where they would want to be.
No, I was actually referring to more from your experience on the LPs you're meeting. So for example, maybe if Ravi can opine, so I'm sure some institutional investors might have come into your funds. But do you really see the depth that can you keep on continuing, and is the market or the LP market wide enough for us to sustain that growth until unless larger institutions are allowed to freely invest into AIFs? Is that I think, I would want to rephrase the question, yeah.
Sure. Well, that is definitely a very pertinent question and a very valid point, that today the depth in the market in terms of investors is just not there. So especially if I can talk about our example, so we have largely institutional clients, whether we have insurance, we have bank, we have non-bank, we have endowment, corporate, HNIs. But while the spread is there, the depth in each segment is not there. Right? There are obviously investors which are well versed in financial markets. So an insurance company knows what investing is all about, knows how to do due diligence, and is now been facilitated by regulation to invest in AIFs. So they're willing to do that. But if you spread it to the entire, you can say, landscape of insurance companies, only a small component of it is actively doing AIFs. Right now, the limit is also so small that it's not really making a lot of impact on the portfolio for them to kind of do an assessment and take the plunge. But with the other investors, what is happening is that those who have tasted mutual funds, who have invested in mutual funds all that time, are now kind of ready to graduate and understand slightly more differentiated products. So there we are seeing some more action, but obviously that is still wider. I believe that once we start returning capital as an industry, we've been growing while you say 1.8 lakh crores, that's more in terms of commitments, then it goes to deployment. And then once you start returning capital, that's when the hockey stick really takes off. In terms of saying that we've seen performance, repeat performance, then we'll get in. It's like how I would have invested in a mutual fund. I would have seen some investments. Once I see that growing, I broad base and I expand.
I think that's a very strong point. Of course, A is the limits, which you said there are limits on how much you want. And of course, when we look at Asia or in the US, a lot of funds which were raised earlier by Sequoia or the likes, they've returned their first few funds and the same money is coming back. So of course, I think what Ravi you're trying to say is that it will take time, but it's something like limits need to be more relaxed and it has to be given time. But I just want to quickly move to Shobhit. Shobhit, you were a part of the team in JLL. where they also had some real estate AIF, and also maybe at some stage Anarock also would want to get into something like this. So again, only on the LP question. So as a international firm, when you were in JLL, what was your response when you went out to the market? What kind of investors did you see, and the depth?
Interesting you ask. It was a tough market to raise money, or it is still continues to be tough for real estate, specifically because they see it as a very illiquid asset class, right? And then, it's not sold very well by the private wealth guys, because it kind of locks in the money for a long time.
Yeah.
So you end up doing sort of deep selling. And everybody that is investing, especially family offices and HNIs, they themselves feel that they have the expertise of investing stroke deal sourcing. So you almost every time you end up competing with your client, saying, can they do it better than you? And that's the large part of the debate. And they haven't really seen too much. And somebody mentioned, actually the life cycle of raising, investing, and then closing. I think every time we've tried to close in real estate, we've always invested in the peak and exited the other way around. So I think our entry exit in the sector as a general AIF hasn't been very eclectic. In fact, if at all, it's a little bit sorry, and you have to keep explaining, saying why he did what he did and how you're going to be different. So it isn't that deep. Insurance companies aren't allowed to put money. LIC was allowed at one point of time, then they had bad experience, they withdrew. So we have only got a host of HNIs. If you want to raise a 200 crore rupee AIF in real estate, you'll probably have close to 160 investors. And that's really painful. Yeah. I mean, it is difficult. In fact, when we bought that business from JLL, and we were thinking what we should do, we actually sort of, in some way, stabilized it, saying we don't want further AIFs. AIFs we'll do with institutional players, right? Not HNIs, because it's just too much investor relationships for too little gain. So I think the risk return wasn't working for us. 200 crores is not the size that you want to raise. You want to raise large size pools. At least $100 million to begin with, but that basically means 400-500 investors,
right.
And that didn't add up. Just managing 400 people, you need an army of IR team doing this work. Yeah, so we said we're not going to get into it. So really, I sort of agree with my fellow panelists, saying is not enough depth in the market at the moment, and unless they allow FIs and insurance to invest, I don't think it makes sense to do it.
Sasha and Bharat?
Yeah, nothing different. There really is no depth. We did our first fund in 2011. It was 100% foreign money. Second fund, as Umang rightly said, Sidbi came in, and we had lots of HNIs come in as well. So large percentage then came from India, so 40% odd. But there's still not enough depth. Just coincidentally, I'm in New York the week after, and I'm meeting two teams of very prominent folks who are very successful, who actually want to do fund of funds for India.
Yeah.
So I think that's a massive opportunity, and I'm encouraging them and praying that they succeed. Because even if there's 100 million funds that they both put up, it'll be fabulous for the ecosystem versus us traveling the world. I go from Luxembourg to Timbuktu raising small funds because the asset class is just too early. There's absolutely no depth right now, and that's something that will continue. And as you rightly said, it's all about exits.
It's all about
exits. So, show me the money. Even my own father asked me, show me the money when he has an LP in my funds. So I'm like, okay, and it's marked up, it's that. All that is fine, buddy, show me the money. So I can't show him the money till I close the funds. And therefore, we have to be patient in this business, like I said. Our fund itself is 2012. So I got 6 more years in the first fund. And you certainly don't want to sell an asset cheap just to show someone the money.
No, so when I say, for example, compare this with listed market. So when I see there's a pool by institutional players or endowments or pension funds for listed equity markets and to be given to emerging managers specifically in the listed side, right? So when you probably travel to the US or even Europe, they are ready to put bets on emerging managers in that sense, right? So there's a lot of inflow which comes in from the FPI route on that. Does that happen to you when you're traveling abroad, you're meeting investors? Does that happen to you? Are they ready to bet on emerging managers and give this 10-year, 12-year money?
So we already have money.
Yeah.
Large institutional investors have invested in K Capital in both Fund 1 and 2 global.
Right.
Our challenge is that we are small, and we remain small by purpose because we want to remain small. It's a strategy. Because we don't want to be too big.
So we're talking about the industry, Sasha. So do you think when you're talking about...
I think as far as VC funds are concerned, all the bigger Indian VC funds, like I can name names like Nexus or Safe Partners, etc., is all 100% global money. So it is happening and it has been happening. They themselves haven't returned.
No, so it's more about local homegrown managers. So it's not about Sequoia and
But if you take a fund like Nexus, it's homegrown.
Yes.
But to their credit, they have all 100% foreign money. Or IDG is kind of
a mix.
Chirate it's called now. Lots of Indian money, lots of foreign money. But Nexus has done it but they had to get to scale to get that capital.
So Umang, actually I'll add something to that, because I think whether it's private equity or VC, I think what happens is there is again a full cycle that, so when you say that, when you are going out, in foreign markets, whether you will find ready LPs to come and back new fund managers. So 10 years back, some of these were new fund managers, right? So you would say Nexus, I think Matrix, and some of the others. I think 10, 12 years back, they were newer, right? Now, they have come through those 2 or 3 cycles. And what happens is that every maybe one cycle of about 10 years, some of the international LPs, then they would say that, okay, in last 10 years' time, in India, we have backed, say, 15 VCs. Let's take a stock on which are the top performers out of that. And they'll say these 6 are the ones, so we are going to re-up and maybe we are going to make 5 times the bigger bet on these fund managers. Balance 10, not all LPs will re-up. But that time you would have another 4 or 6, I think, who would have come and who would have sort of been their early stage of, their first cycle. So this, I think, way of churn, I think keeps happening every time that you would see in a span of 8 to 10 years time, 5 or 6 emerging, which continue, which were new, I think, earlier, and then 3 or 4 newer emerging like that. Even in private equity, if you see, that's the same way. That if 8 years back you would have seen, it would have been just an ICICI venture, or some of the other ones. Now, a few of one of them have gone in oblivion, right? For various reasons. Teams have dissipated, international interest in that has waned down, and there are newer people who have come. So, you will have Kedara, multiples, and all those people coming up. So there is interest, but also the fact that internationally, lots of institutional LPs, there is a large class which says that they would not come in a first-time fund. So one has to work with that kind of a restraint.
Perfect. So now, just probably some discussion on AIFs and the regulations. Can they kind of turn out as vehicles of innovation? Right. So maybe talking to Shobhit about that. So when you look at the real estate asset class itself, so it could be an AIF which could be high yielding debt. It could be an AIF which buys commercial properties. It could be an AIF which buys residential properties. So have you ever thought of AIFs as a vehicle of innovation?
100%. I think there's a big opportunity out there. And although we kept saying on the stage that there's no depth on the sector, but whatever little bit there is, there's specialization that's emerging. So we're getting, even within real estate, we're getting alternatives. So we're getting senior living, we're getting student co-living, we're getting WeWork type of products. Then there is even within assisted living or senior living, there are categories. And suddenly all of this is sort of coming alive. Earlier, if you spoke about real estate, there were just 3 things. There's commercial, residential, retail. Now we talk about logistics warehouses, we talk about alternatives, education. There's a K-12 fund that has come in. Goldman Sachs has put money in education fund. So lots of new things that are coming in. All of these are through AIFs. All of these new structures that have come in ultimately fold up to an AIF, and then AIF can do what they want to do. So I don't think there's any restriction. We are not, wish list never ends, but I think government has done enough there. You can obviously change and tweak a few things, but I think it's there to stay.
Good. Sasha, your experience on this?
It's similar. When we started, everyone was doing the same thing. But now when we go to Bangalore, I was sitting in a Microsoft meeting about a month back, and everyone said, introduce your fund. So 2 years back, maybe everyone would have said the same thing. We do tech, we do this. But 20 to 30% of the funds talked about doing only AI or only education or only whatever. So we're seeing that, obviously that's not innovation, it's just getting into a new sector. But the fact is that you're getting a segregation of the market where people are going deeper. And the entrepreneurs are expecting that, to someone to stand up and say, do you really understand this? What value can you add? Is it just dumb money or is there going to be some value add to it? And so it's very early days because the market's still, like we said earlier, small. But we're seeing green shoots of funds come up and stand for something different from just saying, here we have money.
No, actually, I have personally seen Sasha do it. So for instance, Sasha, you've not mentioned this to the audience, but I was mentioning about this bubble getting created on the VC side, because if SIDBI has to deploy 10,000 crores and they're going to only put 25% in each fund, so that in the seed side you've got a 40,000 crore pool, but there is nobody who comes in and invests in the second stage. So there's no Series A, B kind of fund, right? It's not to that kind of magnitude. And then Sasha stood up and I think is launching a fund which goes on into follow-on offering. So I think each circumstance leads to some kind of an opportunity. And I think the AIF industry is being smart enough to catch hold of such opportunities. Bharat, your thoughts on this? No.
So surely, I think I would feel that in any case, I think one SIDBI, I think launching that kind of a fund, I think is one example, and it is to an extent extremely narrowly focused.
Correct.
So it might sound very simple, but if just someone can just work on Ministry of Finance to say that out of that portion itself, I think they should have split up into the stages of this thing.
Correct.
Then you normally, I think very quickly you will have Series A funds also coming up. And in terms of specialization, I think you are seeing, I think, newer funds coming up with specific focus on AI, or, some of the people who are only focused on fintech, because that's what they understand the best. And, but it has always been about, whether it's a theme-specific fund where they have expertise, but for the startups and for the ventures who are looking for money, it has always been at the fund manager who is going to be actually investing in my company and sitting on my board. How well does he understand my business? So between two competing funds who sort of, I find as a startup to take money from, I would rather go to a sort of fund where the person who's going to be interacting with me day in and day out understands my business very much. So at a individual level, I think it has always been there. It's just that at the fund level, I think now we are seeing many more such strategies coming up.
Perfect. Ravi, last thoughts from you, and then we'll open up for Q&A.
Definitely. There is obviously differentiation on both sides. One is, as all the panelists have pointed out, very specialized focus areas where you invest. Right? And there is an appetite for those. There is differentiation being built up. But I would say that even on the structuring side, what an AIF is giving you is the ability to really structure a fund, customize the offering. By that, what I mean is you can have differential redemption kind of structures. You can have risk-return tranching. So for our own investor products, we have different levels of risk and return as per their appetite. So that tranching helps to really channel capital towards sectors where somebody may not really want to participate. So whether it's a partial guarantee, whether you pull together other structures. So there is a lot to be done on the innovation side to really draw capital out of it. This expectation that just because it's an AIF, it's a natural progression from, say, the mutual funds, will probably not materialize till we actually go out there and do some work on the structuring side. Say one of the holy grails is corporate finance, corporate money. That there's a huge amount of corporate money in the industry, but that's not an LP for most of the AIFs. But we ourselves are working on a product which can potentially target this to have corporate money go into, say, lower rated debt. And what would be needed to bridge that gap? So Anarock works on a lot of such structuring solutions, but the AIF industry also needs to look at this flexibility that is provided on the product side to kind of draw in capital and expand the scope. And to use a very crude analogy, right? Don't take it literally, but so there is cable TV which appeals and which is part of every household. And then there are offerings such as Netflix, right? Which is customized, where there is a consumer specific to that. Your daily food can be dal khichdi, but a dal khichdi from Bombay canteen is a specialized offering which allows you to get ingredients from other parts of the country as well. So you can specialize, you can have a set of investors which will have appetite for your product as long as you structure it and offer it on their plate. And I think a little bit of that innovation in the AIF industry needs to be there to kind of differentiate from the other products which are currently out there and really go out there and make that effort to deepen the pool. I think that's my take on this thing.
Perfect. So we've covered the asset classes, their role in diversification. We've covered the LP scene and also AIFs as vehicle of innovations. We can take questions now, and also maybe any other topics you want to ask questions to the panel. We are there. Yes. Mike here, please. Mike.
Yeah, thank you. Question with two parts for Sasha and Bharat. Around 2016, there's some research published by Bain and Company, as I recall, which said that the most successful very early stage funds in the US are ones which go for a home run in all their investments rather than balance their risk out. Would you agree on that and its applicability in the Indian environment? And for Bharat, last 3 years we have seen a trend that very early stage investments, the number of deals has been steadily going down. Do you believe that is likely to change, or what needs to be done to change that around? Thanks.
So maybe I can go first. Our whole business is the power law business, and it's all about that 100x return, and that's constant. I used to work in a US fund for many, many years, and I remember we were struggling. We did PayPal, 1.7 billion. The second fund, same thing, struggled. We did a company called Waze in the UK, 1 billion. Third fund, we did a company called Cabbage, 2.2 billion. Fourth fund, we did a company called Coupa, it's 3.3 billion. Point being, no one remembers anything else. And we can show off on the stage like this and say, we did Coupa or Waze. But that's the business. I left that fund in 2011. I'm still getting carry checks in 2018. Or 2012 I left. Right? Same thing in our business. It's all about 50, 100, 200x. Now it sounds absurd. Mostly it doesn't happen. But every investment we do, if we don't think that this can be 100x, we don't do it. And we sometimes do it, and then we regret later saying, oh God, there's going to be a 5 or 10x. And most companies, they die. So in our mission, we did 10x returns. We have to actually strike that off and say we have to change this. We're not thinking big enough. It has to be 100x. When I made Oyo, I didn't invest in Oyo. Who would think it would be 5 billion? I'm going to Harvard Business School this weekend for my yearly degree, and we're doing the Oyo case. And the entrepreneur was in front of me in 2011. Now I'm studying about him in HPS, next week. So that's the beauty of this business. It's crazy. Now, if someone told me to invest in Oyo and I did it, it would all be luck to be sitting here and saying, wow, I invest in Oyo. Because at that point, no one had a clue. But the entrepreneur was outstanding.
So incidentally, I'll add to Sasha, because I was first invested in Oyo. So it's very coincidental that he mentions that. And see, I think, just like, as a student, when we are picking up, 8 subjects where you want to go and appear, you don't expect and you don't sort of start studying for that, thinking that, this is my weak spot, in this I'm going to score 30%, and the other ones are going to make up for it. Investing is no different. I think, when you are picking up, I think all your bets, 10, 12, 20, whatever you pick up for diversification, you all see some spark in that. As a manager, I think you see some spark in all of them. Now, there could be various reasons on why everyone doesn't sort of work out linearly that way. But it's not that you don't start with that sort of particular discipline, except that, as a disciplined manager, I think, when you get into the second cycle of, say, a few years down the line, couple of years down the line, how each one is shaping up also decides whether you back them further or not. Because then there's a question of, cutting short your losses. I think, that's the point, that if this entrepreneur, I think, is losing steam, then do I sort of get a validation from another backer of investor to think I'm on wrong path? And then do I get validation for that? Then I'm also happy to back him again. So the fact is that when you start, I think you start at the same sort of podium, to start with. Eventually, where you land up, I think, is a function of many things. And incidentally, I think for some of the more active managers, where you land up also is a part of, what you were able to contribute, guide or not guide. Sometimes, entrepreneurs become a little bit stiff in terms of not taking that input. Sometimes the managers become very stiff about, what the kind of inputs that they want to give. So I think it's all in hindsight that one could say, on that first point. The second point I think that you asked was the fact in last 3 years' time, the sort of early stage investing actually has been falling quite a bit. So again, that has to do with the fact that angel investing actually has been going on for last about 8 or 9 years' time. I think, other panelists did make that mention of the point that, you are excited to sort of make more bets if you are seeing cash coming in. I think for angels, I think, you have seen blockbuster, I think, exits only recently last 2 years' time. I think for last 3 years' time, a lot of money had only gone in the startups. So you would have seen, I think, a big blockbuster exit for people, who were early investors in Flipkart. Some of us like, I think, people who were investors in OYO. And there are other 10, 12 examples, I think, that you have. So maybe that is one reason. Second also is the fact that some bit of fatigue does set in, at a point in time. That, what I think Umang was just saying that where is this Series A and Series B? So how long can you just keep investing angel and pre-Series A and seed when you don't have enough actually next level kind of funding coming in? So as that funding is opening up now, I think you will see again maybe in a year or two, I think that picking up. Hope that answers your question.
Any more questions? So thank you everyone for making us to this panel. I'll just invite you to come and